Thank you, Dave, for the kind introduction and asking me to present today on ESG investing and why you should consider investing now. My name is Frank Fantozzi. I've been a proud member of Entrepreneurs Organization for the past 14 years, and I look forward to introducing you to the world of ESG investing. Besides supporting EO through their three initiatives of zero hunger, clean water and sanitation, and affordable clean energy, you can also have an impact on your society by how you choose to invest. So today's primer will provide a backdrop on what is ESG investing and how you can approach ESG investing on an individual level and or through your company-sponsored retirement plan if they provide ESG investments. So let's dive right in. The world is not short of headlines. It's changing with environmental and social pressures growing more acute. It seems like climate change, cybersecurity, and income inequality are always in the headlines, and it has been for the past few decades. Headlines that impact the planet are also headlines that impact your portfolio. But please keep in mind that bad news sells more than good news. And this is not to diminish these issues. It's just to make sure that you create context when you look at investing and how you research. So it's important that we peel back the onion at all the relationships that exist and why we may perceive certain actions as right or wrong and how they impact us and the world around us and really how they are all connected. So I'd recommend a book to you to help create some context and share really on how the world is improving. It might not be as fast as we wish or to say we've achieved these goals, but it shows that we may be heading in the right direction. So the book I'm referencing is a book called Factfulness, 10 Reasons Why We're Wrong About the World and Why Things Are Better Than You Think. It was written in 2008 by a Swedish statistician, Hans Rosling, with his son Ola Rosling and daughter-in-law Anna Rosling. So please check that book out, and I think it'll make you feel better about where we're at, but the journey's not over. So the good news is there is a growing realization that sustainable companies can be part of a solution to today's global challenge. And on the flip side, investment managers are trying to avoid investments in companies that present a high sustainability related risk. For investors, this rapidly changing landscape creates opportunity to potentially reduce your own risk and improve your own returns. So let's explore why responsible investing matters and how investors are making it an integral part of their investment selection process. So before we continue, let's define a few key terms. When we say responsible investing or responsible investment, we mean looking at companies not just through the lens of financial factors, but also through the lens of non-financial factors, which may help investors gain long-term performance advantages. So companies that look to be an asset not only to themselves, but look to their shareholders as well, and include how the society will benefit around them. Responsible investment is an approach to investing that aims to incorporate environmental, social, and governance factors into investment decisions to better manage risk, generate sustainable and long-term returns. So what gets involved in all these ESG factors? So below are examples of environmental, social, and governance factors. It's not a complete list, but I think it gives you an idea of what you will start to look at when you evaluate companies at an environmental level, which looks at energy management and efficiency, environmental impact of products, waste management, air and water pollution, and the like. Social factors can be product safety and ethics, supply chain human rights, employee diversity, consumer data security. And governments really looks at leadership and management, board structure and gender diversity, accounting policies, lobbying, political contributions. So this is it's not an all-inclusive list, but it's a list that gets you started in what you need to be thinking about when you add that additional lens. So maybe the next chart will help kind of put that in better perspective. So what we're going to do is look at traditional financial analysis, which has really been how we've looked at investing for many years. combine it with ESG factors to create a more comprehensive investment process. So it's really a more holistic approach to investing. So what we do is combine this financial analysis, which is price to earnings ratio, earnings per share, return on equity, all the fun numbers that, guys like me like to talk about, but look at all these other factors of environmental, social, and governance, combine it as part of our analysis and say, all right, how does this company measure up? How are they looking at their standards so that they're more than just a bunch of numbers on a spreadsheet, that by how they lead, by how they impact the society around them and their environment, they're not only making a difference, at the company level and impacting the shareholder value, but impacting the world around them. So how this started was with socially responsible investing. This was the predecessor to ESG investing. It's the simplest and often the least expensive value-based investment approach, where environmental, social, and corporate governance investing focuses on companies making an active effort. Okay, it's not passive, it's an active effort by the decision-making they make quarter to quarter, year to year, to either limit their negative social impact or deliver benefits to society, or both. So on the screen, you'll see what I call exclusionary screening, which is more about social responsible investing. An example would be an industry such as fossil fuels. You might say, well, if a company is involved in fossil fuels, just by that alone, they'll be excluded, or adhere to Catholic, if they're not adhering to Catholic values, that is another one that would just exclude the investment without looking at its ESG factors. When you really look at ESG factors, you're really looking at data on the company's policies and practices and see how they're incorporating this in their decision making. All right. And then what they do is they measure the impact that that company has based on measurable data to see, is there a social impact by what they do? Is there an environmental impact along with a financial return? So this is how we've approached and moved away from just SRI investing to ESG investing. So who's interested in responsible investing? Well, broadly speaking, responsible investing appeals to two types of investors. Those are value-based investors who want their portfolios to reflect their values. They believe in corporations that should be held accountable for their actions, that care deeply about the environment and social issues, which informs them how they, as an investor, should think about their investments. While traditional investors seek opportunities to pursue their investment goals while managing portfolio risk, they recognize the negative impact that climate risk, bad gender policies, and human rights violations could have on their portfolio. So, keep in mind that wanting to build a better world and wanting to build a better portfolio are not necessarily mutually exclusive, and that the decision to invest responsibly may be driven by a combination of these two motivations. So let's look at, a few major trends in responsible investing and the movement towards more responsible investing. So responsible investing has been around. It's just gaining more and more momentum. Interest has reached an all-time high, according to a survey published by Morgan Stanley in 2009. More than 8 in 10 U.S. individual investors now express an interest, while half take part in at least one responsible investment activity. Interest is running high amongst millennials, but keep in mind that responsible investing is not just a millennial trend. While alignment with values is very important to younger investors, studies show that Gen Xers and baby boomers like myself are now also putting their values and actions by how they invest and measuring that. Clearly, what you'll see on the next chart is the most visible of all the themes, major themes, is climate change. So climate change will be a dominant theme as governments across the globe introduce more climate-related regulations. As a result, I would expect to see net zero emissions by companies and investors to become a standard practice by the end of this decade. All sectors will participate in this transition to low carbon economy because companies recognize the risks that if they don't, it will drastically impact how they're viewed in regards to how they address climate change. Many firms will look to seize new business opportunities and position themselves as climate leaders and use this as a marketing differentiator. At the same time, investors will increase engagements around climate change and will look to incorporate climate risk into their voting policies. And that's something we'll get to later, going so far as to vote against board of directors for lagged responses to this matter. You'll see clean technology obviously also is high, emissions and waste management, human rights, and cybersecurity are gaining more momentum. So really across the spectrum, these are becoming issues that matter to investors. So it's not just looking at these trends, but actually looking at the flow of money. And what this graph shows, going back to 1995, where this was really starting to be measured, you could see today that 26% of the assets in professionally managed monies actually represent ESG investing. Money managers know that people are holding them accountable, and they're in turn holding companies they select to fit their portfolio accountable. So if you want people to buy their stock, the companies are going to have to step up. Another important trend is reporting. So, where do you go find this information? Well, it usually starts at the top. As a growing demand for more and better ESG data, companies are changing their reporting practices to better reflect their commitments to sustainability. Really, only 8 years ago, just 20% of the S&P 500, which are your 500 biggest publicly traded companies, reported on relevant ESG risks. As of 2019, 90% of these companies now produce reports of this kind. Now, there is no industry standard in reporting, but we see that this will happen as more and more companies do this. As more companies adopt ESG metrics and report this data, and more of the related data becomes available, responsible investing should continue to gain momentum because this data is going to get highlighted. So you can do this alone, looking at a prospectus of individual stocks, or you can look at prospectuses of mutual funds and look at how the management team of the mutual fund is evaluating and building ESG valuation systems on the stocks they select. Or you can hire an advisor like myself to help you develop an ESG portfolio if you chose not to do it alone. But again, there's no standardization on these reports yet. And we see this happening as more companies beyond the S&P 500 hop on board with ESG reporting. There is a business case for ESG investing, and it's grounded in a lot of empirical studies linking the relationship between ESG and performance. So this chart shows that the results of the bar graph here count that there is a high correlation on the study found with more positive correlation than negative that performance is directly linked to ESG factors. So this is something as an investor you're going to want to experience and make part of your evaluation. We all are charitable at a certain level, but if our ESG investments don't perform, will you continue to funnel dollars there? But I do think this will become a standard and a differentiating factor and something that becomes published more frequently by the leaders in their respective industries saying, listen, here's another difference between me and my competition. They might produce cars, we produce cars, but we are much more an effective ESG corporate steward in how we manage our company, manage and work with our employees, and impact the world around us. So I would see this as a trend, and you'll notice it more probably as it comes up in marketing. But it is something that companies will look to delineate themselves as a way of directing you to purchase their assets and or to invest in those companies. Another trend worth noting is the responsible investment strategies increasingly go beyond what I call exclusionary screening to assess how well a company is positioned to respond to ESG risks and opportunities. As we talked about earlier, the initial approach to responsible investing involved excluding companies with objectionable business practices from portfolios. For example, industries that were linked to tobacco, alcohol, gambling, fossil fuels were screened out. And while negative screening is still a popular investment approach, we believe investors can now take advantage of a more sophisticated tool and strategy. So, for example, combining traditional financial analysis and ESG can paint a clearer and more complete picture of a company's actual risk. Again, an ESG risk for not stepping up to the plate and making a difference in those areas. And this can really create opportunities in regards to investment risk, reducing investment risk and opportunities to invest for better return. So responsible managed assets grew to 17.1 trillion by the start of 2020. And according to the latest report on U.S. sustainable, responsible, and impact investing trends in the United States alone, $1 of $3 collected now is ESG factors into those decisions and how that money is spent. And so you can see that in the graph that there are becoming more and more options to look at in regards to responsible investing. As it gains ground, investment managers are offering more and more ESG focused investments. In 2002, there were approximately 280 registered investment companies, basically mutual funds, that have incorporated ESG factors into their investment process. In 2020, that figure has risen to approximately 830, an almost threefold increase in just 10 years. And that trend will just continue. So what is your unique approach to responsible investing? So building your own ESG portfolio can be challenging because no two investment managers have the same investment approach, capabilities, or track record. It may be a timely opportunity for investors to look at building a well-diversified portfolio while pursuing competitive returns and a positive impact by using ESG. So examples of such companies, who have demonstrated and had significant assets under management in these areas are companies called Calvert, 1919, BlackRock, Nuveen, Gilead, Vanguard, Parasus, and IMAX, which are a few of the more well-known mutual fund families that offer ESG options. Industry sectors is another example where there could be higher or lesser exposure than others based on the company you're evaluating. So by evaluating the ability of companies to navigate financially material ESG issues, there are investment opportunities and risks that can be identified that might not otherwise be apparent. So what this chart is showing you that depending on the industry that you're in, if I'm, for example, in the software industry, is energy management a high level of ESG risk, where human capital development and privacy and data security are more at the top of the list. So depending on the industry sector and or the company will probably drive what factors kind of rise to the table that what you need to look at in evaluating those various investments. Another thing to consider is engaging with management. Again, there's a difference when you're investing individually with that stock and how you vote your proxies, or vote yourself as a shareholder, or if you are looking at mutual fund managers to do this. But what's really important is how do they engage management through direct dialogue, proxy voting, shareholder resolutions, written campaigns, multi-stakeholder initiatives and public policy initiatives. Depending on the issues and how management is engaged, this is critical. So, I've always stated, people can say a lot of things, but it's really what they do that you get judged by. So looking at how companies actually develop and implement and create results through their ESG behavior is what things that should be measured and looked at. So again, one way to look at this is, how is shareholder engagement? Now, again, you can be a shareholder and engage individually, or if you're using a mutual fund manager, how are they voting? So mutual funds use proxy voting, have a proxy voting record, and it's a prime example of what I call active shareholder engagement. And while some investment managers might vote in lockstep, so that means, wow, whatever management says, we're just going to rubber stamp. Maybe those mutual fund managers, get a little bit of ding next to them because they're really not challenging management to come to the plate, where other managers are not voting in lockstep and are challenging management with regards to their initiatives. And so you're going to see in those regards that shareholders and the proxy voting by the shareholders are disagreeing with management. So this is one way to see, is there active engagement? Is management being challenged and being held accountable to their ESG commitments? So, one of the big questions is, do you sacrifice performance? And this is just one example. It's not an endorsement, but I wanted to show you an example of, this common misconception, which is incorporating ESG considerations in an investment portfolio doesn't mean you have to sacrifice returns. And that companies, they're actually focusing on sustainability that can not only benefit society, but they can also benefit their investors by favorable performance, because companies that follow better practices get noticed. It's think about it in this regards. Would you go to an attorney that's not a JD? Would you go to a manufacturing company that doesn't follow ISO standards, which are really important in regards to the quality of their machining processes? These are things that need to be looked at. And I believe ESG will be a delineation of companies that are better and to be looked at with higher regard versus companies that have a poor ESG report card. So think of it in that regards. How does their report card look in regards to ESG matters? And you'll see by this example, this company, this mutual fund called Calcor, which gets measured to its benchmark, which is the Russell 1000. So you think of the S&P 500 as your top 500 companies. The Russell 1000 is your top 1,000 companies in regards to market capitalization, which is their basically intrinsic net worth. So again, we don't believe that that you'll have to sacrifice performance, but again, every investment has its risk and there's nothing guaranteed. So still, you have to do the due diligence of financial analysis and now combine it with ESG analysis. So at the end of the day, it really comes down to you. How do you uncover your preferences and motivations? What issues or themes are you interested in addressing your investments? Is it about social? It's about climate? Any of these that drive your inside feelings are going to be important in designing your portfolio to represent you. Do you have a geographic interest? Is it global? Is it United States? Is it Europe? Which engagement strategies are you most interested in exploring? Are you looking at active or passive investment? A passive investment might be an ETF, or what they call an exchange traded fund, which uses a formula to invest without any really regards to what's going on in the market and making judgments about this is a better time to buy into this industry or this sector at this time. And what is your preferred approach to building diversity? How much should ESG investing be part of your diversification process, which means not putting all your investments in one basket? So we talked about personal investing, which is something you can do. But for many Americans, their largest single investment account will be their corporate retirement plan, whether it's a 401k plan or 403b or a SEP IRA. These are all different types of company retirement plans. So you need to first find out, does your company even offer these types of investments? And if they don't, you really need to talk to whether it's the head of HR, the CFO, or the president, depending on the size of the company and who's responsible for setting policy. But keep in mind that a company is a trusted fiduciary. They have a responsibility to make sure that the investment assets that are being offered meet certain criteria. So ESG is just not alone. There's other criteria, and this is defined in the company's IPS statement or investment policy statement. It really sets down how the company goes through their investment selection process, how it goes through their monitoring to say, we're offering these investments and believe these investments will meet the needs of their team. And again, assets fall into different categories: US, international, fixed income, balanced, because believe it or not, companies that are ESG actually borrow money, and that's where the fixed income portion comes in. So we need to understand what the company is doing, and you have to engage with your company if you don't have ESG investing. So let's summarize what we've covered today and then conclude the presentation and open it up for any questions. Why responsible investing? Well, there's environmental and social pressures that are driving companies to act. Investors now feel it's more important that besides getting a rate of return, ESG matters. It's a reflection of who they are and their value system. It's an opportunity to influence corporate change and behavior and make it a positive change. And again, if your company doesn't offer these types of benefits through their corporate sponsored retirement plan, you need to ask. Again, the trend is, and it's growing, that there is a need for responsible investing and that there is a link, a positive link between ESG and corporate financial performance. And I think, again, it will become more of a distinction going forward and something that companies will use to separate themselves in another manner, especially from the competition. And investment approaches that also go beyond negative exclusion, which means there's critical factors that you look at that is needed in ESG investing to make those decisions. So with that, I want to thank Dave and EO for inviting myself and Plan Financial Services to represent this educational component on ESG investing. If there are any questions at all, don't think of them as silly, too basic. Our job is to make sure that you have the right information to make clear, confident, informed decisions. You can feel free to call me or email me. I provided our information on the screen. And again, we're excited that EO is getting behind Zero Hunger in regards to their initiative, as well as clean energy and access to water. And I've included a couple slides on these initiatives. Again, Zero Hunger and what Cleveland's doing in this regards, clean water and sanitation. And then affordable and clean energy. So let's all go out and make a difference by how we choose to invest and incorporate ESG investing in our way of generating returns, not only in our portfolio, but making a difference in the society around us. Thank you.